Hello and welcome to the Trading School. We are here to help the small investor, the beginner, someone just starting out, small account, but not here to sell you anything. So today let's jump in and talk about an indicator which a lot of people use, not saying it's the best, but it's very well known. So the moving averages. I have on the screen a red line, which is a 50-day moving average, and a blue line, in this case, is a 200-day moving averages. You can change the length of time on moving averages to whatever suits your preference, what you like to see, what's been working for you, your time at looking at stock charts and etc. For me, the most popular one is either a 30 or a 50-day. In this case, we're going to use a 50-day as a red line here. On the screen, I've got a symbol up, MAR for Marriott. And at this point, what we're looking for is for a stock to move above the 50-day moving average as an indication as to when to get into the market, and vice versa. When the stock moves down below the 50-day average, it's a good indication you may want to get out. There's a lot of other things we need to consider other than just crossing below that line. But in this case, since June 27, that stock has crossed above the 50-day moving average. What is a moving average? It's nothing more than a calculation, for example, from this date all the way back 50 days. Take it back here, for example, there's 50 days. That's a long indication of what direction is a stock moving. So we know, just by looking at it, we know it's moving upward. But as time changes, this could come back down to and cross this 50-day line. We don't know that yet. We just have to wait and see. Now you can change. Now if this is 50, that means it's 50 trading days. Now you can change your time frame on your chart to look at a weekly view. Now when that happens, this 50 is not 50 days anymore. It's now 50 weeks. There's typically 5 trading days in a week. So it now goes out to 50 weeks. So in this case, we go back 50. I think I've got room on the chart. Yeah, that goes all the way back to September of last year. It's a long time. So in this case, what you need to do, if you change to a weekly and you still want to see your 50-day moving average, change that to a 10. 10 fives is 50. So now we have what's called a 50-day average we're looking at. In this case, it's a 10-week average, but you can see what it looks like. It changes the perspective of the chart. But remember, we're looking at weekly time frames. This is a week, there's a week, there's a week. Let's go back to what we want to do in this class. In this case, we'll switch this back to 50. Okay. Now, if you're using a 50-day average, a 30-day, a 21, whatever your preference is, that is typically for a short-term investor, meaning shorter the average, the shorter the time frame you want to get in, get out. For example, someone could get in here and the stock would go up and down, and you may want to get out over here. You made maybe 1 or 2% in 16 days, 16 bars. So a long-term investor may be looking at the 200-day average, which is at the bottom, the blue line. If it crosses here, he'll probably want to get in, give it a confirmation of one more day and get in here. And if that being the case, that's March the 29th, all the way up to the present, he could have stayed in and had 23% increase. No guarantees. Remember that there's no guarantees in the market. So while it's impossible to predict the future of a specific stock, using technical analysis and research can help you make a better prediction. A rising moving average indicates it's in an uptrend. A declining, don't have one here, but slightly declining here, it's in a downtrend. Let's look at some other examples, other stocks. Caterpillar, for example. Here we've had a good uptrend, and you could have got in the market here if you started June the 2nd, or give it a 1 or 2 day confirmation just to make sure it's going to stay above. Here's one more, Copco or Conoco, COP. There again, crossing the 50-day line. You could still be in. Now, in some cases, investors they're using two indicators here, for example, the 50 and a 200. Now, if the 50 would cross below the 200-day average, a lot of investors, and this is not something that you have to do, but a lot of investors would probably not want to get in as this is staying below the 200-day average. Now you can see it's starting an uptrend here, so you put it on your watch list, and when this does cross over, might be a good time to buy. So that's when you'd get in, and it would still be in the uptrend today. Here's one or two more. Amazon. That's a fairly short term. If you got in here on May 25, it would have crossed over, the 50 would have crossed over the 200-day line. It makes you feel safe and comfortable, but as I said before, there is no guarantees. So let's take this off. So you can use the Pacific moving average. You can change the time frame, like I said before, 5, 9, 13, 21, 30, 50. They're all good, but it's what is going to suit your needs. And one thing a moving average will do, if you work a plan, and that plan is to get in when it crosses above the average, if you stay with the plan, you can protect your capital. In other words, protect your portfolio. You may get whipped out in and out sometimes. For example, you could have been whipped out here. It crossed, but it did not close below. This one crossed, but did not close below the 50-day average. So, but there's no guarantees. But if you had a strategy of getting in when it crosses and getting out, or crosses above and getting out when you crosses below, that takes all the emotion out because you're working your plan. So myself, I like to use a 30 or a 50-day moving average. Sometimes I'll have them both on the screen. I use the 30 in order to get in the stock at an earlier time. Sometimes it's not a good move and I get whipsawed back out. But if I stay with the 50 and the 30, I can see a direction that the 30 is crossing over the 50 and it's moving in an upward direction. There's a few more on indicators. Oh, here's a good one. General Electric. What a straight line that has been. Almost a straight line. Let's take it out to a 1 year movement. So just before the end of the year, people could have got in here. It crossed above the 50-day moving average. and stayed above it all the way, and it's getting close to coming back down. Now that brings up another subject. A lot of people will go in here and add to their position when this pulls back close to or touches the 50-day line. Let that add back to and touch the 50-day line here. Add to it. Go up and back to and touches the 50-day line. They'll keep adding. So the boys on Wall Street, they keep adding more and more stock as they go. If their strategy is to buy $100 million worth of GE, they don't buy it in one day. They will buy some here, they'll buy some at this point. Each of these where you had a little bit of pullback in the stock itself, so they can continue riding the wave. So a few takeaways from today. Moving average is just an indicator. It's a mathematical indicator. It gives you at a quick glance, stock moving up, moving average moving up, stock above it, you're good. If it falls below the average and you use your strategy, you can get out. There's no one particular indicator that works for everything. You just have to find one that works for you. In this case, this is referred to as a simple moving average. There's no special calculation into it. Some people will use a exponential moving average, which gives more weight, more credence to the last few days, last few weeks of the moving average. It's just a little bit different line than what you see here, but that's the simple moving average. Is if you're new to this and still learning, that's what I would stick with at this point in time. So at this point, let's say, remember the key takeaways. Take out emotion. The moving average cannot predict the forecast, future, and all it does, it just helps to level or smooth out the price data. So that's about it for right now. So hit the like button if you like, subscribe, and give us a thumbs up, and we'll catch you next time and as we add more to this learning series. So take care. Thanks.